Some multifamily deals look expensive at first glance, and sometimes they are. But sometimes the problem is not the price. The problem is that the investor has not underwritten the debt properly yet. In this video, I want to show you why serious investors do not judge a multifamily opportunity by purchase price alone. Because in larger residential and commercial multifamily investing, the quality of the debt can completely change how the deal performs. And if you skip that step, you may reject the deal before you actually understand it. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined, CMHC-eligible multifamily investing, not surface-level deal reactions. Stay with me until the end, because I'm going to break down why the real question is not always, is this property expensive? The better question is, what does the debt structure do to the investment? Most investors see a high purchase price and immediately get defensive. They compare it to smaller properties. They compare it to what they bought years ago. They compare it to what they think the market should be. And that reaction is understandable. Nobody wants to overpay. But the issue is that a price reaction is not the same thing as underwriting. A price reaction tells you how the deal feels. Underwriting tells you how the deal works. That difference matters because a deal can feel expensive before you understand the financing, and a deal can feel attractive before you realize the debt structure does not support it. So the first impression is not enough. The structure has to be tested. Purchase price is important, but it is only one input. The real investment performance depends on how that price interacts with income, expenses, leverage, amortization, interest rate, reserves, stabilization, and debt service. That is where many investors stop too early. They look at the top line number and assume they already know the answer. But in multifamily, the financing can change the shape of the deal, not in a magical way, not by removing risk, but by changing how much pressure the asset has to carry every month. And that is the key. A property does not only have to justify its price, it has to survive its debt service. If the debt is too aggressive, even a good asset can feel tight. If the debt is structured properly, the same asset can become much more stable to hold. This is where CMHC-eligible financing becomes important, because the debt is not evaluated the same way as a basic residential mortgage. In the right structure, the underwriting looks closely at the asset, the income, the operating performance, the debt service coverage, and the long-term viability of the project. That does not mean every deal qualifies, and it does not mean a high price suddenly becomes acceptable. But it does mean the investor has to evaluate the deal through the correct financing lens. This is why two investors can look at the same opportunity and come to different conclusions. One sees a price they do not like, the other sees an asset that needs to be underwritten against the right debt structure. That second investor is usually seeing more of the deal. The reason amortization matters is simple. A longer amortization can reduce annual debt pressure compared to a shorter one. And when debt pressure is lower, the projected cash flow and debt service coverage can look very different. Leverage matters as well. If the deal can support a stronger financing structure, the investor may be able to preserve more capital while still controlling a larger asset. But this only works if the income, expenses, and underwriting support it. The debt has to match the deal. It cannot just be forced onto the deal. That is why serious investors do not only ask, is this a cheap property? They ask, is this the right asset with the right debt? Because a cheap property with bad debt can become difficult to hold, and a more expensive property with better debt may be more investable than it first appears. Quick question for you. When you see a multifamily deal for the first time, what do you react to first? The purchase price, the projected cash flow, the interest rate, or the amortization? Drop it in the comments. I read through them, and it helps shape what I break down in future videos. Here's the real underwriting question. Can the asset support the debt in a way that makes the investment stable, realistic, and worth pursuing? That is different from asking whether the price looks high. Because price is static, debt structure is dynamic. It affects cash flow. It affects flexibility. It affects downside protection. It affects whether the investor can actually hold the asset through normal operating pressure. And in multifamily, holding power matters. So the takeaway is this. Do not reject a multifamily deal just because the price feels high at first glance. And do not accept a deal just because the price feels low. Underwrite the debt. Look at the amortization, look at the leverage, look at the debt service coverage, look at how the financing supports the asset over time. Because the deal is not just the building. The deal is the building plus the debt structure attached to it. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and the parts of the deal that are easy to miss if you only look at the surface numbers. And if there's a topic you want me to cover next, drop it in the comments. I read through them and it helps shape future videos. If you want to explore opportunities that have already been filtered through this kind of process, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.